How are we doing today, folks? Seems a little bit quiet. I think I know why. Valentine's Day. Yeah. Everybody's trying to say what they're going to do for their significant other, and they're just kind of like, I don't have good ideas. Hoping that Dr. Barnes will come up with and bail them out at the last second. I got bad news for you. I'm a bad source of information for that. Although apparently Dr. Caden thought something was going on because she thought I was listening to Taylor Swift today, apparently inspired by that. Dylan's actually a lot nodding, heard the whole conversation. I was just had my headphones in and I was just kind of blissfully just kind of like this. And she's like, oh, what are you listening to? So Bad Blood says, oh, Taylor Swift. And I was like, no, no, not that Bad Blood. Not that Bad Blood. So yeah, true story. True story. All right. So speaking of bad blood, we are in chapter 7 and 8, and we got introduced to Dr. J at the beginning of chapter 7. Dr. J, did anybody get the reference, by the way? Because he's talked about, it's like, I used to play basketball. And that's a joke that would have been very, very funny to my generation, but I don't know if anybody knows who Dr. J is. He's not quite as famous as like Michael Jordan or LeBron James, but it's Julius Erving. He was actually a very well-known basketball player back in the 70s and early 80s. So that's kind of a timely appropriate joke, but you can kind of tell what generation Dr. Rosen comes from. Dr. J. Rosen is his name. I was not so much interested in Dr. J as I was interested in Kevin Hunter's story. So Kevin Hunter was a consultant with Walgreens, and they had a partnership, and basically Walgreens went to Theranos and said, hey, we want to do this deal, but we would like to learn more about your technology. And Theranos probably said, no. All right. Said, well, we need to know about this. We're going to do something. And they said, no, still no. All right. Kevin Hunter says, we don't know that this is a viable technology. You've not shown us any evidence that you've got a working product. And they said, no. And then finally, Kevin Hunter said, look, we've got to get this resolved. It doesn't seem like you've got a working product or any intention of showing us a working product. Elizabeth and Sonny said, get this guy off of here. He's asking too many questions. Now, there was a term that was used in the chapter 7 that I thought was very apropos. It's called red flags. Have we heard that term anywhere before? Yeah, I think that there were probably quite a few red flags in this particular context, and the lack of transparency, certainly a lack of transparency, which we've talked about internally, but externally also. And there's not a little knowledge. They kind of use this veil of trade secrets, and they use that kind of to obscure what's going on. They're really, really heavy on security. I will say, moving forward, and I try not to do this too much, but I find myself doing it too often. This is kind of the beginning of this use of the term trade secrets to obscure problems within the organization. And there's going to be a lot more use of that term moving forward and from a legal perspective. But I do recognize that many organizations, they have proprietary concerns. They have certain issues that are certain items and certain procedures that they don't want the rest of the world to know, because that would kind of undermine their ability to gain a competitive advantage. But Theranos kind of uses this as a bludgeon to obscure the fact that they do not have any real insightful or even working products. Any type of process or working products. And so, yeah, that was kind of the thing with Walgreens, and we'll hear more about Walgreens moving forward. But then we talked about Safeway and Steve Bird, bought Elizabeth Holmes an airplane. Okay, it was a model airplane, but he was basically saying, you're going to have your own very, very soon. And so, yeah, Safeway is kind of going to be the grocery store distributor, and Walgreens is going to be the retail chain distributor. We'll talk a little bit more about it, but the way that Theranos was able to kind of pull the wool over both of their eyes is really impressive. I will say that, and something I will say consistently about Elizabeth Holmes is that if she had put her efforts into something legitimate, she might have been able to legitimately change the world. The fact that she was able to accomplish as much as she did with just basically smoke and mirrors was pretty impressive. I really wanted to go to like the West Coast. I wanted to see some of these Safeway stores and Walgreens stores that changed their store structure to accommodate the Theranos blood testing systems. Because we'll hear more about that. Basically, Theranos kind of dictates the term and says, you guys are going to have to remodel your stores so that you can accommodate Theranos. And the Safeway and Walgreens stores, they did exactly just that. And I would have loved to have seen what kind of came up with that, because obviously Theranos is not in business anymore. But see how they actually managed to accommodate that. Would have been fascinating. Anyway, so yeah, that was chapter 7. Chapter 8 talked about the mini lab, which is their new testing device. And I think that this chapter was kind of best summed up by Sonny's perspective of the whole issue. Is that basically what they had to do is they had to take 4 existing blood testing devices and kind of combine them into one blood testing device that was supposed to be small and compact, because Elizabeth had this thing about wanting it to be small, wanted to be able to fit in the palm of your hand or something along those lines. And they talked about the challenges of that. But Sonny just thought, yeah, you just toss all these devices into one system and just run it, and it'll work perfectly. And yeah, that shows a that just shows not just somebody who is ignorant, but willfully ignorant about the process. I'm not going to say that I have any knowledge about blood testing devices. I'm a little bit more knowledgeable after reading this book multiple times, but I could tell you that if you try to take multiple systems that are trying to do different things and you try to combine them together, you're probably going to have a lot of problems with that. I think the illustration that was given earlier in the book was still applicable here is the web of rubber bands. That if you pull on one rubber band, it's going to actually extend other ones, and it creates problems in other areas. That's going to be something that going to happen with the devices of this type. So that was kind of the issue they ran into. And of course, we have a little bit more overview of the problem with corporate culture. Elizabeth did hire her brother, though, okay, because her brother is an expert in blood testing, all right, was very, very knowledgeable in this area and solved all the problems that Theranos is going through, right? Right? No, because he was a corporate toady. That's basically why he got hired on. It's like a yes man, along with all of his Duke brethren. I kind of was hoping that my brother was going to be very, very successful, so I could actually just take a job with him and make hundreds of $1,000s in a Silicon Valley job, and just basically all I have to do is read ESPN all day. I do have to say that all jokes aside, and maybe I shouldn't say this on a recorded video, I took a little bit of fondness from his approach about reading the ESPN articles, because I did that during slow times at KPMG. It's like I didn't want to be seen reading websites. So the copy and paste in the email, that's an old trick. Okay, that's an old trick. I probably shouldn't be telling you all that, but we've already read the book and you already picked it up now. So if you're ever just like, okay, I want to read about what happened last night in the game, but my boss is sitting on my shoulder, copy, paste, put in an email. Okay, as long as your boss is not reading too closely what you're reading, then you get away with it. All right. What you learned about today in auditing, we like to learn about how to get away with reading stuff we shouldn't in our job. Okay. We all have to take a break every now and then. You gotta keep it kind of light. Anyway, yeah. So Theranos fired a whole bunch more employees, and the wheels keep turning, and so we're moving forward there. We've not gotten into any improvements in the corporate culture. In fact, basically Elizabeth is becoming more tyrannical. She's going to wine gardens and giving 45-minute speeches like she's an army general, and that's kind of where the mindset is at moving forward. Everybody's a little bit afraid of her, very afraid of Sonny. And, we kind of seen with Sonny, not quite at his worst yet, but Sonny starting to get a little bit more disparaging, a little bit more cruel. All right, with that, we're moving on to CPA prep. Okay. So you have to give me a second here. My iPad was updating when I was trying to pull up my notes here. I suppose I can do my standard talk amongst yourselves. What is your favorite part of this Theranos saga right now? Who's your favorite character in Theranos? The Sonny? Everybody loves Sonny, right? All right. Hold on a second. I promise I'll get there in just a moment. What is it you like most about Sonny? Let's talk about that. It's a cool fashion style.
Did he use chest hair part of his outfit?
That's right. That's right. Yeah. Shows an extreme lack of taste. Extreme lack of common sense, which I have been accused of that before, but not in that regard. All right. Which of the following procedures an auditor most likely include in the initial planning of financial statement audits? So keep in mind here, this is a question, this type of question that comes up a lot on the CPA exam. It has to do with what occurs during which phase of the audit. And this is a pretty easy one because we're talking about planning phase. So which are the things that we would actually do during planning phase? So obtaining a written representation letter from the client's management. What phase of the audit does that usually take place? What point in the audit, I guess I should say? Manager representation. Does anybody remember? Towards the end. So does anybody remember what the manager representation letter is? So that's a document that is composed by the auditor, but it's addressed as from the management to the client. And it basically says, here's everything that we provided for you over the course of the audit, and we need to attest and claim that these are consistent, okay? It's a really weird document. It's usually, like I said, usually composed by the auditor, but it's written as from the management to the auditor, which, the idea being is the auditor has a much better idea of everything the management provided than the auditor did. So that's why it's written that way. So that occurs near the end of the audit. Examining documents detecting the non-compliance with laws and regulations having a material effect on the financial statements. That sounds like testing to me. That sure sounds like it'd probably be substantive testing. So that can be there in the phase. Considering whether the client's accounting estimates are reasonable in the circumstances. Probably need to know what those estimates are before you can actually do that. And that would not occur during planning. That would be a testing item as well. Determine the extent of involvement of the client's internal auditors. Yes, that we have that now. We have that. That would be something that we would consider. By the way, something that came up, we talked about it auditing. We talked about the nature of internal audit. We have to consider basically 3 items. 2 of these are required by the ASB. We have to consider the objectivity and the competence of the internal audit function. We're talking about PCOB audits. We also have to consider their use of a systematic and disciplined approach. But can we use the work of internal auditors? Yes, if they meet all those criteria for the situation. All right. For which of the following judgments may an independent auditor share responsibility with entity's internal auditor is assessed to be both competent and objective? Ooh, there's competent and objective here. Here's the deal. You guys are going to hate me for including this question, but I included this question for a reason. It's because you have to be very careful about the wording in questions. I do not like the fact that I used to listen to a podcast by the ACCT talking about the CPA exam. It's called This Way to CPA. They stopped doing the recording, but one of them, several times in the podcast, they insisted they do not write CPA exam questions to trick candidates, all right? I'm just going to tell you right now, this is a trick question, all right? This is a trick question. Now, it's written by Becker, so maybe that's part of it. I would not anticipate that you'd have something that's so deceptive on this, but I do think it's important to make sure you read the entire context of the question to be able to answer the question. So let's go through this first statement, okay? Which of the following judgments may an independent auditor share responsibility? Stop. Do we share responsibility for any of the judgments we make as external auditors? No, it doesn't really matter what the rest of the words are. We know none of them, okay? It doesn't matter what the rest of the question is. We do not share any judgments, okay? Now, if we were talking about which of the following could we actually obtain additional assurance from the internal audit function, that's a competent objective. Both of these could actually give us assurance in this area, but they're not responsible for assessing judgment. We as the external auditor provide the judgments only. So the answer to this one is going to be no for both of these, simply because it's, like I said, it's a trick question. Again, you're probably going to be really, really angry at me for including this question. Say, Dr. Barnes, why would you do that? Again, I want you to get in the habit of reading the entire question and not just accepting the question at face value. That term judgment is really, really important in the context of this question. Which of the following is the least likely to affect an auditor's judgment about materiality? Okay. All right. This one's kind of an interesting one. It kind of reflects back on something we've talked about in 417. So the nature of an item, such as an illegal but very small payment, would that affect our assessment of materiality? Certainly. Illegal acts would be a consideration of risk that would affect materiality. The client's evaluation of materiality. Does this client have any input as to what our evaluation of materiality is? No, it's an auditor self-assessed one. So this is likely our answer, but let's go through the rest. Dollar amount of key figures in the previous year's financial statements. Could we actually use that as a judgment of materiality? Yeah, in fact, we did that back when we did this, we did Earthware. We talked about the difference between the current period and the previous period and trying to make them comparable when we were doing a materiality back then. I know it's been a while for many of you talking about that, but we do consider information from previous years as well as current years. Consideration of what a reasonable person would think. Is a reasonable person relevant to materiality? Yes, that's part of the definition. What would affect the judgment or decision-making of a reasonable user of the financial statement. So B is our answer. All right, here we go. Jamie from MSM CPA firm is auditing RC airplanes for year 3. Jamie expects the user of the financial statements to have a medium to high level of tolerance for the misstatements and to be most interested in earnings. Okay, so we're getting this column right here, medium to high level. Most interested in earnings. So what does that tell you if they're most interested in earnings? What is this company likely to be? Profit-oriented company or not profit-oriented company? Profit-oriented. Okay, so important to note. MSM CPA firm has the following audit guidance for calculating materiality and to obtain the following information for their financial statements based on the facts above. What was the overall materiality Jamie should use for RC airplanes? Well, medium to high says 6%. Okay. Or sorry, so 6% or 1%, depending on the benchmark we use. But our benchmark, we pretty much established if they have a focus on earnings, they're likely a pro-profit entity, meaning profit before tax is probably our best benchmark. All right. Most relevant to the financial statements, kind of focused on earnings. Now, when would this change? We're talking about a not-for-profit company. We would probably not want to use earnings for income taxes. Is there another scenario that we've talked about where we might not want to use earnings as maybe a profit-oriented company, but profit is not the focus of the organization? Yeah, investments or mutual funds, asset-based entities, basically how we would term that. That would be an example of that. But in this particular situation, top profit before taxes, 6%, 6% times 250,000, we get $15,000 B. That was a pretty straightforward one, but the key here is not because you do the calculation in a simple scenario, but did you consider all the possible other scenarios in their situation? There's a lot to decompress there. Like, wouldn't it be the scenario that we'd use total assets? What information do we have to take from here? Again, you want to keep out for all the relevant pieces of information. I thought this was a good question, even though ultimately I think it was a pretty simple answer. The existence of audit risk is recognized by the statement in the Auditor Standard Reports. All right. So when we talk about audit risk, what is the nature of audit risk? Audit risk basically says that the client could issue materially misstated financial statements, or could say that the financial statements are free from material misstatement when in fact there are material misstatements. Basically, they issue a clean opinion on materially misstated financial statements. Okay. Now, does that mean that the auditor screwed up? Not necessarily. Okay, it's possible the auditor screwed up, but it could be that they made a mistake just simply because the nature of the audit is that it's possible an error could exist or a misstatement could exist, even though we did do everything with due professional care and strong diligence. What is that concept called? Saying that we can't guarantee that everything will be detected. Not absolute assurance, but reasonable assurance. Okay, so that's the term that we're looking for here. We look in D, it says auditor obtains reasonable assurance about whether the financial statements are free of material misstatement. Not absolute assurance, reasonable assurance, meaning that there's still a possibility that an error or misstatement could exist, but we're reasonably certain that one does not exist. Okay, that is the whole core of audit risk, is that reasonable assurance gap that exists. Now, again, we could say, why don't we provide higher assurance? Keep in mind, reasonable assurance is a very high level of assurance. We're talking about like 95% in many scenarios. In really extreme audits, you can go to 99%. So there's still a risk there. It's still a risk. It's impossible to get rid of all the remaining risk because we are not immortal. Okay, we don't have infinite resources or infinite time. As the acceptable level of detection risk increases, the assurance directly provided from what? All right, so let's talk about the nature of the audit risk model. So audit risk is a function of three components. What are they? Inherent risk, control risk, and detection risk. Yes, okay. So detection risk comes at the end there. Inherent risk and control risk make up a concept called what? Risk of material misstatement. Yes, okay. As risk of material misstatement goes up, what happens to detection risk? Goes down. As risk of material misstatement goes down, detection risk. All right. Now let's talk about detection risk. Detection risk. If we say high detection risk, is that a good thing or a bad thing? So we say risk and we think bad. That's bad. Is that true? No. Remember, when we say high risk, we're talking about tolerance for risk. Detection risk is really, really weird in the fact that it's inverse of what we expect. And don't feel bad if you've forgotten that. Again, this was something I did not understand until graduate school. I completely and totally nerfed on it because my instructor did not explain it well when I was an undergraduate. And so I was like, detection risk, high detection risk, bad. No, we're talking about the auditor's tolerance for risk. If it's high detection risk, that means they can tolerate a lot of risk, okay? So what about low detection risk? Low detection risk, is that a bad thing or a good thing? It's a good thing. If we have low detection risk, that means that we can tolerate, or sorry, bad thing. Did I say good thing? I meant bad thing. It's a bad thing. But low detection risk, that means we can't tolerate a lot of risk, so we have to do more work, okay? So keep in mind, the test of controls, that actually dictates control risk. We've already established control risk by the time we establish detection risk, so we can ignore C and D. So it's going to be A or B, all right? So if detection risk decreases, what does that mean? It means that we've said that we have a low tolerance for risk, meaning we have to do more work. So substantive tests should increase. Yes, the test should increase, okay? So A is our answer. Which of the following statements reflects an auditor's responsibility for detecting errors and fraud, okay? So let's just go through the answers and go through each of these because I think that's the best way to associate this. It's going to become pretty obvious once you get to the right answer. Auditor is responsible for detecting employee errors and fraud, but not for discovering fraud by involving employee collusion or management override. So is an auditor necessarily responsible for detecting employee errors or fraud? No. They're responsible for designing audit procedures that can have a reasonable, or I don't want to use that term. You see where I'm going with this. That can detect illegal acts that have a direct material effect on the financial statements. I left out a term, but you probably know what the term is because I gave it away. All right, auditors should plan the audit to detect errors and fraud that are caused by departures from GAAP. Nope, nope, it doesn't really matter whether they have departures from GAAP or just got responsibility in general. Auditor is not responsible for detecting errors or fraud unless the application of gas would result in such detection. No, it's not true. There's not a responsibility in general, okay? It's more about a reasonable responsibility. Auditor should design the audit procedure, audit to provide reasonable assurance detecting errors or fraud that are material to financial statements. Again, illegal acts that have a direct and material effect, okay? And there's that reasonable assurance statement that we know over encompasses anything that auditor does, okay? So D is our answer. D is our answer. The most reasonable answer, for lack of a better word. What's the synonym for reasonable? All right. I'm gonna leave you guys with that assignment for next week. My first question on Monday will be, what's a synonym for reasonable? Synonym for reasonable. I think I said cinnamon. Oh, all right. I'm losing my mind. I can't spell Janine and I can't say cinnamon. All right.
Plausible.
Plausible. Okay, there we go. I'm just gonna say plausible assurance from now on. All right. For which of the following journal entries would the auditor least likely examine? Which of the following journal entries would the auditor least likely examine to an effort to address the risk of management override of controls? All right. So talking about management override, we know that management override does exist. It's a natural limitation of internal controls, inherent limitation. Okay. We do have to have management override does exist, but when's the most likely scenario that management override controls exist? These are going to be for journal entries that are fairly uncommon. They're not frequent in occurrence. Usually if we're talking about period end journal entries or some sort of adjusting journal entries or something that's unique in nature. So if we're talking about the least likely, that would be the opposite. It's something that's recurring and very frequent. We're not likely to see management override of controls in that area because they occur so frequently. If that's the case, A says a journal entry made to record reoccurring periodic accounting estimates. That sure sounds like the one that I was just talking about right there, something that occurs fairly frequently. So A is our answer, but let's go through the rest. A journal entry made by an individual does not typically make journal entries. Would that be a red flag to you all in an audit? Say, why is this person who's never made a journal entry now making a journal entry? It's like, okay, are they trying to manipulate financial statements by management override? Certainly a possibility. A journal entry recorded as a post-closing entry has no explanation or description. I will tell you right now, back when I used to do journal entry testing, if it had no explanation or description, that was an automatic red flag in our testing. That was one that we said, all right, we have to investigate this. Unless it was like a 1 cent journal entry, then we're saying, okay, unless somebody's embezzling 1 cent, we're going to ignore it because it's not material. A journal entry made to a seldom used account. This one's a little bit less obvious, but I still think it follows in. It's like if somebody is trying to make some sort of manipulation, they may record it to an account that does not have a lot of oversight, especially if an account with not a material balance. So all of these make sense. We're talking about management override. The only one that doesn't really make sense is A. All right. For our TBS, I will tell you right now, this TBS, I thought it was going to be really great when I created it and I put it together, and I still think it's fine, but there's a little bit of challenge there because I do think that there's some overlap in some of these answers. So I don't think that you would see something quite as opaque or as difficult to interpret on the CPA exam. But I still think it's worthwhile to think about, and especially as it relates to fraud risk factors. So basically, in the scenarios below, we're going to select each appropriate fraud risk factors, which remember, those are our fraud risk triangle, pressure, opportunity, rationalization, which we've talked about a lot in 620. And then we're also going to talk about what is going to be the type of misstatement, whether it's going to be relating to fraudulent financial reporting and misappropriation of assets. That should be the easy one to discern. The one challenge, believe it or not, is actually going to be the fraud risk factors. All right. So significant related party transactions not in the ordinary course of business. This actually is this first one's a pretty easy one. Okay. So out of the fraud risk factors, pressure, opportunity, rationalization, which one does this most likely align with? There's related party transactions. Those are allowed. And there's probably a significant opportunity for fraud to exist. Okay. Now, which is going to be more likely, misappropriation of assets or fraudulent financial reporting? I'll be honest, it could actually be both of these, simply because if you are talking about transactions with other parties that are related parties, you could actually divert revenue or divert resources to them that they don't allow. But more generally speaking, I think the more likely scenario is going to be fraudulent financial reporting. It can be considered as such. So opportunities, fraudulent financial reporting. Again, if you do not have the exact answers here, again, the goal here is to understand these at a more fundamental level, not to make sure that you get 100% of this activity. I don't think that I could do this 100% on my own simply because of just some of the nuances associated here. Promotions, compensation, and other rewards inconsistent with expectations. All right, so this is an interesting one. This one's a little bit more easy if we think about it from the perspective of, all right, if you accomplish a certain goal that we don't expect you to accomplish, we're going to give you additional rewards. Okay. So like an example would be this, like management stock-based compensation. If they reach an earnings target that they think is just not possible to earn, they would say, we're going to give you additional stock options. So we think about it from that perspective. What does that represent from the fraud risk or factor perspective? Pressure. Yeah, it's an incentive or pressure. Yeah. And which area could we talk about this would this most likely be aligned with? Misappropriation. So yeah, the Becker actually says in misappropriation assets, I think that you can make an argument for both again. Okay. Especially if we're talking about like performance and stock-based compensation, you can make an argument that would be fraudulent financial reporting. But they actually make the argument that promotion compensation are inconsistent with expectations. That would actually be misappropriation assets because that's not something we would expect to see. And so this is the answer given. Again, if you had a different answer here, don't sweat it too much. Significant bank accounts in tax haven jurisdictions for which there appear to be no clear business justification. I do not like this question at all, okay, but it was included in there, so I included it here. So fraud risk factors. My personal answer to this one is I thought this might represent more of an opportunity to this one. This is not one. Could there be a justification for another one of the fraud risk factors here? So the one that they operate, the one that they say in the Becker, the one answer they have is they say attitudes or rationalizations. And my only interpretation of this is that saying if we're talking about operations in other locales, that they may have different rules that are in place. We talked a little bit about this in forensics yesterday. We talked about corruption in other countries, not necessarily viewed as corruption. Kickbacks are okay. Okay, so that kickbacks for soccer. All right. So yeah, kickbacks are okay. So that could actually be a form of rationalization. I don't necessarily buy it, but I think this one's a little bit clearer with respect to what type of reporting fraud we're dealing with. This is going to be fraudulent financial reporting. So again, I'm going to put up what their answer is. I don't agree with this one. I think this is more opportunity than anything. All right, large amounts of cash on hand or processed. All right, so large amounts of cash on hand. What do we know about cash with respect to fraud? Cash can be stolen, Dr. Burns. You're absolutely right. Why can cash be stolen? It's a bearer instrument, okay? It's a very liquid asset. It's the most liquid asset. That's what we're trying to convert most of our assets to. It's entirely possible that if you go steal a cheeseburger, you're not going to convert that to cash. You're just going to eat the cheeseburger, okay? But for the most part, most of our conversions are trying to get to cash. So that's going to be a liquid item. So what does that represent? A shining example of with respect to the fraud factors, that there's a lot of cash on hand. I'd say that's an opportunity. That's an opportunity just waiting. Cash to get stolen. All right. And if cash is getting stolen, what is that an example of? Which fraud? Misappropriation of assets. Yes. Ineffective board of directors, audit committee oversight over internal control. All right. So the company does not have good oversight. It's like Theranos doesn't have good oversight, so they can commit fraud. So if there's lack of oversight, or with the puppet board of directors, what do we say that the executives have an overabundance of if there's lack of oversight? Opportunity. Yeah, not much pressure, not much rationalization, because they can just get away with whatever they want. So a lot of opportunity there, but this one's going to be opportunity associated with fraudulent financial reporting. All right, inadequate physical safeguards over cash, investments, or inventory. All right, so you got a warehouse and the door should be locked, but the lock is broken, so they've never bothered to fix it because that would take time and effort and money. Okay, and who has that kind of time and effort and money except for every employee there? Yeah, but yeah, so the door is broken. Anybody can walk into the warehouse and steal a good. So that sure sounds like what was that example of? Give me a hint. It's very similar to what we talked about in the last two questions. Opportunity, rationalization. You just did that to throw me off. Yeah, thanks, Dylan. All right, opportunity and misappropriation of assets. All right, here's an interesting one. New accounting, statutory, or regulatory requirements. I actually like this one. So you're operating an organization, you're operating in a business and within a particular industry, and everything's going well. You manage to maintain pace. All of a sudden, new regime comes in place and says, all right, The accounting rules that you currently follow are no longer reasonable. A good example of this was like a little less than 10 years ago when companies were expensing all of their operating leases, and they came in and say, you can't do that anymore. You have to represent some sort of asset effect. So you recognize the long-term asset effect. So it actually adversely affects your financial statement reporting. What is that going to be an example of from a fraud risk perspective? A new pressure. Okay. All right. Nobody got my joke there. All right. All right. David Bowie, Queen, great song. Okay. Under pressure. What's that? It is nice too. Okay. Yeah. We'll remember to put that on the playlist when like Professor Templeton does. We'll play some background. I'll play those songs back to back under pressure and ice. All right, this is really getting off the rails. Sorry guys. Pressure. All right, and probably going to be associated with financial reporting. Maybe I've got it in your head now that you're actually going to be humming that during your CPA exam and doing that plan. And then you'll answer everything pressure and then you'll feel bad. Excessive interest by management in maintaining or increasing the entity's stock price. All right. Now this one's an interesting one because I think that it can actually be a little bit of both. I think there's a relationship here. So can we argue that this might actually represent some sort of pressure? I think we can make an argument for pressure. Can we also make an argument that this represents some sort of attitude or rationalization? Yeah, so this is one of those ones that's not clear. I think you'd be fine answering either one, which is why I don't think it's a particularly good question. But it's good to talk about because we understand that it represents both. So if we're talking about maintaining or increasing stock price, are we going to be focused on misappropriation of assets or fraudulent financial reporting? Fraudulent financial reporting. And we're going to say attitudes and rationalizations because that's what Becker says. Now, if you answered pressure here, I think that's also a legitimate answer. All right. Management has significant financial interests in the entity. All right. So basically, you're a manager of an organization. You've gotten all these stock options. You vested your stock options and gone ahead and bought the stock in the company. So your livelihood is based on the company's likelihood. The company does badly, you do badly. That's got like a textbook example of. That's pressure. That is pressure. Okay. And that's going to be the fraudulent financial reporting we just talked about because we want to make sure the company is reporting well. Inadequate monitoring controls, including automated controls and controls over interim financial reporting. This one's an easy one. The controls are bad, fraud is easier. What is that an example of? Opportunity, okay? And we could say either one of these, but I think in the particular situation where we're talking about bypassing controls, probably more focused on fraudulent financial reporting rather than misappropriation assets. Now, keep in mind, we're talking about reporting. Fraudulent financial reporting is more likely. That doesn't mean we're stuck just to that. Controls can exist with respect to physical safeguards, security, et cetera. But the fact that they talk about controls over automated controls and controls over reporting indicate this is probably going to be something related to fraudulent financial reporting. All right. Management failing to correct known significant deficiencies on a timely basis. This one, I'm not sure if this is a clever question or not, because this one is I really struggled with. I didn't think it really cleanly fell into any of the three. What do you guys think? Does this sound like a pressure? I don't think this is a pressure. What about an opportunity? I could see the argument for opportunity. All right. How about rationalization? I see some people think rationalization, and that's actually what Becker identifies this as. All right. Failing to correct a significant deficiency on a timely basis. So the rationalization attitude would be that it's not important to correct those significant deficiencies is basically what I came up with. Now, this is kind of reverse engineered because I didn't know what the correct answer was. So I kind of looked at Becker's explanation of this. I'm not particularly happy with this. I think they could have done a little bit better job explaining this. The answer is going to be attitude rationalization. With respect to significant deficiencies, we're talking about deficiencies in internal control. What do we usually report on internal controls? When we report significant deficiencies as an auditor, what types of controls are we specifically referring to in that scenario? Remember, we have three different objectives of controls: operations, compliance, and reporting. Which one of those is the big focus of auditors? Internal controls over financial reporting. Yeah, so we're probably talking about reporting, meaning this is going to be fraudulent financial reporting. Long way to get to that particular answer, but it's a good exercise to go through. Again, I wouldn't fret too much if your answers are not close to this. Again, the goal of this is to think about the nature of fraud risk factors and how to apply them, and more appropriately to be able to figure out which one is going to be more applicable, which fraud scenario. if it's fraudulent financial reporting, misappropriation of assets. So good reflection on there. All right, well, I think that does it for this week. We'll be back next week. I think we've got a couple of nap cases next week, so I'll see you guys then.